Hello, everybody, and welcome to the Like a Tortoise channel. Here we are. I'm recording this on a Tuesday, February the 10th. And today's video is about Hallo. I know some of you asked me to analyze this company in the last YouTube live call. I mean, I can't. I'm sorry, but I just don't remember which of you asked me to analyze this company. But I will do it. I will do so in today's video. Okay, so I already noted down some of the names that you guys wanted me to analyze. I've already covered some of them, and the goal is to crack on with it. All right. So, is Hallo a good investment at today's prices? Does this company has a sustainable competitive advantage? As always, there is only so much that I can discuss in these videos. So I will tell you my take on from a financial standpoint. But I can see, for example, that they are in the healthcare space, right? So therapeutic. So if you know about the industry, I'm not sure if you are working in the industry. If you are, then you certainly have an edge over me because I have no idea about healthcare. And in fact, my circle of competence does not include healthcare, the healthcare sector, which is why I always avoid investing in these companies, even though, as you well know, because I've made it very clear, some of our clients have also decided to invest in some of the healthcare names. For example, Novo Nordisk is a good example. And so, yeah, here we go. But let's discuss Hallo from a fundamental standpoint, okay? So right off the bat, I can see that this is the daily. Let me change this to the weekly charts. Oh, wow. Okay, so this is, I'm showing you the stock analysis tool, right? But you can see, if you are new to the channel, I don't use eToro to execute my transactions, right? So I use Interactive Brokers instead, which is a broker, definitely my broker. The Liker Tortoise broker, because I use this broker to execute all of our transactions for the Liker Tortoise portfolio. Okay, so it's interesting that the company did nothing from 2002 to 2019, right? 2012 all the way to 2020, but now recently they have really skyrocketed. So what exactly happened here? Let's try to find out. And let's start by looking at our stock unlock tool. And we can see that the stock unlock gives it a 4.5 score out of 5, which is very, very good. And I don't think the company is that expensive either. In fact, it's not expensive at all. But we will look into this, okay? Now let's start. So let's read a bit more about the company. So they are in the biotechnology space, okay? So that is certainly the healthcare sector, as I already mentioned. They are headquartered in San Diego, California, currently employ 350 full-time employees. Okay, they IPO'd on 2003, so we have our preferred long-term record, right? You know that I like to see companies with at least 10 years of I like to see at least 10 years of financial data, because this really makes the process easier at the time of making an investment decision. I like a lot of visibility into those financials. Going back many years. So the firm's commercially validated solution, enhanced drug delivery technology with the proprietary enzyme. God damn it, I hate this stuff. I mean, all these things, this is part of the reason why I just stayed away from healthcare companies, because I don't understand this stuff and I find it absolutely boring. It's boring. I mean, Hylex, the company also has a proprietary ultra high concentration microparticle formulation technology for biologics. Anyway, good. So let's discuss the financials of the business. So it's been on a massive tear on an absolute tear since the end of 2000, since the beginning of 2020. Starting with the income statement, let's see what we have. So revenues have compounded nicely, I assume. Yeah, exactly. Yeah, but things really took off from 2020. Look at that, right? So they were growing. They actually jumped in 2017, then collapsed revenues. But then since 2018, primarily since 2019, things really skyrocketed, which coincided with the sharp increase in the share price, right? And if I go here to earnings, all right, so this is a problem. If you know me, you know that I don't like companies that have just turned the corner to profitability, because that creates a lot of uncertainty going forward. And you can see that going back to 2012, the company has always been unprofitable. There was a profitable year in 2017, but you see it immediately collapsed. We have no consistency, which makes predictability virtually impossible. Since 2020, however, right, we have this jump. And again, this is why the stock has been on an absolute tear, because yes, profitability is now increasing massively. But look at that. I mean, it jumped all the way, jumped from 129 million to 400 million, and then it crashed back down to about 200 million. But now, slow and steady, we are definitely moving up, and there was a big jump right here. Let me zoom in on the quarter. Yeah, I mean, this is exactly what you want to see. So on a quarterly basis, you can see that the last quarter delivered a very good, delivered a very positive growth in the company's net income. So this is good. However, remember, we only have like 4 or 5 years of profitability. I don't really like that. All right. So this may, in all likelihood, will already exclude, right? It will already stop me from wanting to do more analysis on a company. I just don't like that. But anyway, let's continue. What about the diluted shares outstanding? Okay, this is definitely very good. Look at that. Since 2012, the company's shares outstanding have been declining. In fact, they were growing. Look at this. So they were growing, right? If I do this from 2012, you can see that they grew from 2012 all the way to a recent peak in 2021. But since 2021, shares outstanding have been declining, which I like it. In addition, let me see something else. Yeah, so because this company was probably they were diluting existing shareholders, but look, if they are still a young company. In fact, they IPO'd many years ago, but because they turned the corner to profitability recently, I'm assuming they did something different regarding their business model. So, I mean, if you are in the space, you make sure you understand why profitability only started after 2019 when the company IPO'd in 2003. Okay, so we have to understand exactly what happened here. Did they pivot the business model? What exactly happened? Did they diversify their revenue streams? Yeah, we need to give answers to these questions. But sure enough, were diluting shares outstanding from 2009 all the way to the present day. You can see that shares outstanding increased by about 50%. So there's a lot of dilution, but it's nice to see that the diluted shares outstanding have been declining since 2019. They declined by about 10%. So I like to see that. Okay. Cool. Let's discuss the balance sheet assets. Let's see what we have. Assets jumping sharply as well. Look at this. Very nice. Again, something happened from 2020 to 2021. Understand what happened. But yeah, look at that. Was this acquisitions? Again, we have to understand the business model. So it's nice to see that. Okay. In terms of cash, it's been very high as well, right? Going back a bit further, yeah, look, we are at so the company is sitting on a very comfortable cash position. We have to have a look at the debt as well. But you can see that liabilities have skyrocketed since 2022. So we probably because of long-term debt. Let me see. All right, so long-term debt, exactly. So the company need to raise funds. And there, as you know, there are only two ways the company can do that. They can dilute existing shareholders, so they can issue more shares, right? In order to get that money from shareholders, or they can also borrow money. Yeah, so they can go to a bank and they can take out a loan. And the company did both, right? Because the number of outstanding shares, while it's decreasing, as of recently, it was going up, right? It jumped 50% over the last 10 years that we checked. And you can see that long term that also skyrocketed into from 2020 to 2021. So again, however, it's nice to see that the assets are growing and revenues have also increased massively, and so did profitability. The biggest red flag is when the companies are taking a lot of debt, but then you see muted or declining revenues and you see declining profitability. All right, just to give you an example. So, okay, let's have a look at their margins. Gross margin fairly stable. The average is about 81%. The latest is about 84%. I like to see that. On a quarterly basis, you can see that this has been going up, right, since the lows, the most recent lows around 2023. I like to see that. But more importantly, if you ask me, is the operating margin, because it's the one that management can control more effectively, right? This includes operating costs, right? And they have, of course, they have a strong control over the operating costs. And you can see, because the company turned the corner to profitability at the end of 2020, right? You can see that this has become positive since then. However, you can see that since then, since 2020, the average is about 52%. Right now we have about 61, and this thing continues to go up since these lows here in 2022. Will it continue? What this tells me is that there has been operating leverage, right, which is good to see. So it can be that revenues. In fact, let me have a look. So let's see what we have here. Since 2021, revenues have compounded by 40%, and you can see that operating income has compounded by about 40% as well. Okay, so and look at this massive jump. Look at that, amazing, right? Operating leverage, ladies and gentlemen. What's happening is that the company is becoming more efficient as it scales, and this is very good, right? It's very, very good. Sure. And also, if I go to net margins, is probably more of the same. Exactly. Big decline here, but since this low of 2022, we are on the way up. And the average is 47. Right now, we are at about 47. So it's nice to see this increasing as of recently. Cool. Let me have a look at other stuff. For example, let's go here to the statistics. I'm now looking at my stock analysis tool. And here you can see, okay, so they have a negative, they have about 54 billion in total debt, and they have cash equivalents so this comes out to 700, about 700 million. When you subtract one from the other, then you get net cash. This is quite a lot of debt. All right. And sure enough, if I go here to the debt to free cash flow and the debt to equity, look at that. Ideally, I like to see debt to equity and I like to see debt to equity under 3. This is at 3.05, which is almost just about in line with my preferred threshold. That's okay. I can also see that on a free cash flow basis, the company produces enough free cash flow. So with the current free cash flows, the company could cover all of its debt within less than 3 years, right? Which is very, very good. Ideally, I like to see this under 3, and that is certainly the case. In addition, the interest coverage ratio, right, the interest coverage is at 41, which is very good. How do you calculate the interest coverage ratio? You do the EBIT, so the operating income, divided by the interest expense. So what this tells me is that the company can easily cover the interest payments on the debt from operating income, which is very, very good. Okay, just to give you some context, I like to see this above 10. We are at 41, so that is remarkable. And so let's have a look at the cash flow statement as well, right? Because now we can see operating cash flow also exploding since 2020. Very good to see. Then we have capital expenditures. What else do we have right here? So They have been buying back stock as well. Makes sense because we saw the share decline since 2020. So this makes sense. And it also tells me, look at this massive jump here, right? It tells me that the company in all likelihood believes the stock is at undervalued, right? That's why they probably jumped. They probably increased the amount of share repurchases. And free cash flows, again, massive jump since 2020. So what do I see here, guys? I see a company that, even though they took on a debt, they have also been growing the business very attractively, right? Not just revenue wise, but also profitability wise. And what's very nice to see as well, look, free cash flow is at about 602 million, right? And net income is about 595. So so this is very good, right? When you see net income pretty much in line with free cash flow, this is what you would really like to see, because over time the net income and free cash flow should always correlate, right? And so it means there is a little manipulation here, which is something that I like to see. But look at this. So effectively, if you do, what about, so look, this is the operating cash flow, and here you have the net income. So because the operating cash flow is higher than net income, it tells you that the company has what I like to see. So it is high cash. So the cash conversion ratio is quite high. It means that the company is converting most of its profits into actual cash, which is very good. And these companies with higher cash conversion ratios, guys, tend to outperform over the long term. So I like to see that as well. Look, there is not much to say here. I like the financials. Let's have a look at the returns on capital, which of course is essential. And in fact, the most important metric of all, if you ask me, is ROIs. I mean, again, we saw this brutal collapse since 2021. And then since 2023, this thing has been going up. But I mean, ROIs of around 44.20%. This is very good. All right, very, very good. Same thing with ROS. Look at that, going up as well. The return on equity is probably the one I don't really pay that much attention to, because it can go up with debt. And the company has contracted a lot of debt. So I like to focus primarily on the company's operations and how efficiently they are generating profits, right? Net operating profit after tax from the invested capital invested in their operations. And Royce will tell me that. Okay, I like to see these numbers right here. And in addition, I can also see that analysts are very bullish, because you can see that the earnings per share growth forecast for the next 5 years is around 17.26%. I don't know why the company is so cheap. Something happened here. Was it the was it is it cheap because of what happened to healthcare companies? And in fact, I showed you this I showed this to our members. Okay, so if you are not aware, let me just go back here to one of our pictures, and this will drive home what I'm trying to convey. But so market valuation and concentration. Look at this. Healthcare index price relative to S&P 500, and you can see that until a few months ago, right? Until a few months ago, you can see that healthcare was trading at the cheapest relative valuation to the S&P 500 since 2000s. And we all know what happened afterwards, right? These companies in the healthcare space went on to deliver absolutely staggering returns for the shareholders. If you are in the healthcare space again, you have what Peter Lynch calls like an edge, because you understand the business, you understand the industry inside out. You definitely understand what the competitive advantage of some of these names. But maybe that's why the stock is still relatively cheap. That's my only assumption, because this is a growth company, as I understand. It's definitely a growth company. Something happened since 2002, since 2019, right? 2020, because the company did nothing. Look at this. From 2007 to about 2020, the stock price, barely moved. And since then, the stock skyrocketed. So something happened, and you have to understand what happened. You can see that analysts rate it as a buy, which is good. But then you can see that the average price target is about 60, 76, which actually is under current levels. Um, let's do a quick math here, okay? Let's say, let me have a look at the free cash flows once again. In fact, let me go here to stock unlock and have a look at the free cash flows. Um, yeah, okay, so this has been going up consistently since 2020. Yeah, let's use free cash flows to do, well, free cash flows and net income are pretty much the same. Um, so let's use net income, and let's do 600. All right. Let's say what we have right here. So let's say we want to double our money in about 5 years. For us to double our money, the stock would need to, so the stock price would have to go to 160, right? So 160. Let's assume what was the average PE for the last 5 years. Let's find that out. If I go here to ratios, look at the PE ratio, right? We will look at the PE ratio, and you can see that, look at that. We have 46, 14, 38, 17. This is a growth name, so I'm going to assume a PE of 20, which is just about average, or the average of the last 5 years right off the bat. So let's assume that. What would that mean? It means if we do, for example, 120, right, divided by our PE of 20, this means we will have earnings per share of about 6. Right now, the earnings per share are at about 4.74. And so if we go here to our growth calculator, if we try to determine, so we have 4.74, excuse me, let's go here. We have 4.74. Our ending value is about 6 in 5 years. What will be the CAGR? And the CAGR is only 4.83%. So the question that you have to ask yourself is, do you think the company can grow earnings per share by at least, say, 4.83% over the next 5 years? And if the answer is yes, then you may have a bargain right here, in my opinion. Because let's face the facts. Since 2020, what has been the earnings per share growth rate? Let's find that out. If I go here, do I have that here? No, income statement. Yes, yearly. Okay. Now let's look at diluted earnings per share since 2020. Okay, so since 2020, yeah, look at this. Since 2020, earnings per share, even already accounting, right? Because I'm using the diluted, I'm using the diluted shares outstanding, even accounting for any dilutive effect since 2020, you can see that earnings per share have jumped have compounded by almost 40% per year. And so, I think it's reasonable, right? It's very conservative to assume about a 5% growth rate over the next 5 years. So I don't understand why the stock is this cheap. Let me check something else for you. For example, if we go, what are the insiders doing? This is going to be interesting. Okay, so I see a lot of selling from financial institutions. What about the executives? Are they buying or are they selling? Okay, so I see independent directors buying. Look at this, independent chairman buying. This guy, chief compliance officer, is buying. I see a lot of buying relative to selling, and this is exactly what you want to see. In addition, take a look at this. You can see that ownership, right? Show only company executives. You can see that the president and CEO has almost 60 million worth of shares. And you can see that all other people have also sizable positions, right? What's the market cap of this company? It's about 9 billion. So this is very good. I like to see that. Yeah, so all the selling frenzy that we see right here is primarily from. Let me have a look. I see the president and CEO has been doing a lot of selling, right? What's going on here? Hold on. So I want insider transactions. This is the ownership. Wait, so I was looking at it. Okay, so I was doing something wrong because the insider transactions actually tells me the opposite. If I go here to insider transactions, look at this, right? I don't know why was I looking at something different because I was looking at a lot of buying. But if I go here to insider transactions, you can see that insiders are selling a lot, namely the CEO. Why is the CEO selling so much stock? Look, always the same guy selling a ton of shares. I don't like to see that. There are many reasons why they would sell, right? But there's only reason why they would buy. And look at this. I see a lot of selling from the president and CEO. Look at that. You see that? And this goes back already to November in September 2015. This guy has been selling quite a lot. So I don't like to see that. Again, understand why this might be happening, but in the ideal scenario, you want to see that you want to see alignment, even though he still owns about 60 million of share or 60 million worth of stock. I want to understand why the selling frenzy. Why has he been selling so much stock? Okay, because it may be that, but I don't think the company is expensive based on my based on my understanding of the financials, right? In how much the company has compounded over the last several years. And sure enough, the free cash flow yield sits at 6.37%. And so does the earnings yield, right? So this is attractive. This is certainly not expensive. I think if the company just delivers even half of what they delivered over the last 5 years, you can double your money in the next 5 years, which is good. But again, I don't like to see that selling pressure, and so understand why that is. Do they pay dividends by any chance? I don't think they do, right? No, they don't pay dividends. Okay, so I think that's it. There is nothing else that I want to highlight here. You can see that stock again, stock and lock score gives them a high score, right? Management, even the share-based compensation is low as a percentage of revenue, which I like to see. Of course, financial health, despite the death, everything is growing as well, which is good. And analysts seem to be constructive. Sure enough, they are projecting 17% earnings per share growth for the next 5 years. So, yeah, just please try to understand